Good evening. This episode of the Intraday Price Action Recap is being brought to you by the Smart Money Manuscript. Hello, my name is Timothy Lee Rogers Sr., and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. That's right, your roadmap to financial freedom. Inside, we're going to be discussing things for absolute beginners who never even heard of the stock market or don't know what the stock market is. We're going to teach what is the stock market, what is a stock, what is an index. We're going to teach all of that. We're going to talk about options. We're going to talk about futures. We're going to talk about fundamental analysis, technical analysis. Speaking of technical analysis, we're going to take a deep dive into the ICT concepts. We're going to discuss how to figure out how much you need as an individual to save for your personal retirement. We're going to talk about retirement portfolios. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. Good evening, everybody. How y'all doing? Hopefully everybody doing well on this Wednesday evening. I feel like I got an eyelash or something in my eye. Hopefully everybody is doing well this evening. If this is your first time tuning in to Tim's Tidbits, allow me to say welcome. I just noticed that I don't have my trading view open. If this is not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty, well, thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That ain't nothing but Big Spider if you don't hablo Espanol. And you are now in tune to the Intraday Price Action Recap, being brought to you by the Smart Money Manuscript. You know, I doubt if it's your first time here, so you know who I am. You know what we're doing. You know what the Smart Money Manuscript is. There's a link pinned to the top of the chat for you to join the Zoom. Pull up in the Zoom. Who all we got up in here? I see we got Jim up in here. What's going on, Jim? We got Deborah up in here. I see the homie Marco up in here. I see Seawalk. I see Here to Learn and Share up in here. I see Kim up in here. What's going on, Kim? I see Felicia up in here. What's going on, Felicia? How you doing? Yeah, them all the names I see right now, so that's all I'm gonna say. Did Price do anything today that caught anybody off guard? If Price did something today that caught you off guard, right? Something that made you go, If Price made you say, there's a link pinned to the top of the chat in YouTube. You click on that link and you can pull up and say, hey, Tim, help me understand this. Today's probably going to be a quick one. Price didn't do much today. I think we had a very productive tape reading stream, right? We got an opportunity to see Price show some. We was able to identify some algorithmic signatures, and Price, it pretty much did what it was supposed to do based off the algorithmic signatures. Is there anyone who was in tune to the tape reader screen today that's on here now? Would you agree with that statement that, the algorithmic signatures that we spied and what we was looking for Price to do, that Price pretty much followed the signature? Phil did start pushing the button, playing around with the delivery. He was pushed the button when I had typed out the the come to Papa, like Michael be doing. Typed out the come to Papa at the liquidity, at the sell side liquidity that we was waiting for it to hit. Phil was playing. He was playing with the button. Every time it come right to that sell side, it'll back up, right to the back up. And when I typed out come to Papa at the bottom, then it went ahead and took the sell side liquidity like we was wanting to. But I guess ain't nobody on here that was on the tape reading stream today. Either that or they don't agree with me. Either way it go, let's get into it. Let's get into it. Let me share my screen and we're gonna excuse me. We're gonna get to it. All right. As you peek over here at the screen there, I don't know where the screen is for you. I don't know if it's dead in the middle. I don't know if it's to the right or to the left, but I do know if I look over here and point like that, I should be pointing in the direction of the chart. I should, like, if I look like this, I should be looking at the lamp. You know what I'm saying? But if I look like this, I should be looking in the direction of the chart. Okay. So this is today's price action, right? As you see, this green candle right there, that's what we started the day off. Okay, right here. This is the this red candle. I'm sorry, that red candle right there, that's what we start today off, right? We had a bearish new day opening gap, meaning that we gapped down from yesterday's closing price at 5 p.m. and the 6 p.m. open price, right? We gapped down slightly. So we had a bearish new day opening gap. That's that gray rectangular box that's hovering right there around yesterday's high, right? And then as you can see, price sort of just consolidated all the way up until 2:30 a.m. Right? During 2:30 a.m., that's during the London kill zone, right? The London kill zone starts right around here, right? This is where the London kill zone starts, right there, around 1:30 a.m. Right? So going into the London kill zone, right? So midnight, right here, that starts a new day, right? Algorithmic speaking. Let's blow it up big and just look at today's. This right here is our dealing range based off of coming into a new day. All right. Coming into a new day. This is our dealing range. We're coming into a new day. If you don't understand how to define a dealing range, right? The algorithm is so nice that it just creates dealing ranges for you. All right. It gives you dealing ranges, weekly dealing ranges, daily dealing ranges. It gives you, it's so nice. It gives you these things, right? Session dealing ranges gives you these things. So coming to a new day, this is our daily dealing range right here. Okay. Now, as we come into the London kill zone, okay, what we're going to notice is that this is the high of our Asian session, right? This is the low of our Asian session, okay? And that's the highest high and the lowest low from our prior session, okay? We start out the new day per the algorithm. This is true day right there. Midnight is when the new day starts for the algorithm. The algorithm runs on New York Eastern Standard Time. I'm not going to say New York time. It runs on Eastern Standard Time. And per Eastern Standard Time, a new day starts at midnight. Right. So this is a new day for the algorithm right here. So once we start this new day here, right, What do you see? We trade up here, take out short-term liquidity, right? We trade down here below the open, take out short-term liquidity, trade into a fair value gap, and then we displace away, right? Create a breakaway gap, create a bullish order block, create a fair value gap, trade back into that fair value gap, and then nothing can stop me. I'm all the way up to there. All right. So as we've been talking time after time in Cyndi Lauper's voice, does this look at all familiar? Right there. Does this look familiar to anybody? What signal rate shore starting at midnight did we get here? Who can tell me that? Who can answer that for me? Nobody?
That's your favorite Judas again. Look like it's what liquidity and went on up.
Wig snatcher. Thank you, C-Walk.
Oh, wait, what did I say? Judas?
Yes.
My bad. My bad.
Yeah. So we went up, took out buy side liquidity, came down, took out sell side liquidity, displaced away, right? Gave an opportunity to participate. And we went up, 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 and away. Right? And if we come here, all right. Hot dog, where did that go? Why does it keep doing that? Oh, you know what? I forgot when I'm on my computer, I can do this. I can go there. I can click the template that I want. And then I can come here. And it's already set up for me. All right. So you can go there. From the high, from the low, back to the high. Right. And that's our, it's all stretched out and not really pretty. Right? It's all stretched out and not really pretty. But this is our manipulation here. Right? We got to swing low here. We got to swing low here. We got to swing low there. Neither one of these, but it's on this side. I'm going with this one because it's the lowest of the two. Right? Looking at the lowest of the two. Right? He stretched out a little bit. Everybody gonna be drawing little smiley faces on their chart like this right here from now on. Right. And then if we look up here, right, we came up here to a half standard deviation there. Well, first of all, right, we came to the anchor point there. Right. We got our breaking structure, creating a breakaway gap there. Right. This breakaway gap here is inside all of this back and forth. Y'all remember on the was it a tape reading stream when I said you have your, when you got your imbalance there inside all that back and forth, and then you get that breaking structure, right? You don't want to see that traded back to. We create a bullish order block without going back to it, and then we create a fair value gap, right? Because price right at this time is exceedingly bullish. Okay. All of this right here is very efficiently delivered. We leave that area, right? Creating a balanced price range. Not only do we create a balanced price range, we create a bullish order block. So now at this time right here, this is not an inefficient area of price, right? This is the inefficient area of price because all of this has been efficiently delivered, right? So this right here is a balanced price range, right? So when price is exceedingly bullish or bearish, you don't want to see those constant retracements, right? What are deep retracements and overlapping candles signatures of?
Yeah, those are signatures of consolidation.
High resistance.
High resistance.
High resistance. Thank you. Thank you. High resistance liquidity runs, deep retracements, and overlapping candles are signatures of high resistance. Consolidation is trading within a range without a willingness to trade outside of it in either direction. Trading within a defined range without a willingness to trade outside of it to either direction. That's consolidation. High resistance is deep retracements and overlapping candles, right? The candles, you Christmas tree trading, red, green, you know what I'm saying? Red, green, no matter if it's moving up and down, red, green, right? Red, green, like the bunch of overlapping candles and a bunch of deep expand, retrace, a lot of deep retracements. When price is exceedingly bullish and or exceedingly bearish and in a low resistance, you don't want to see deep retracements. You want to see it come back to an inefficiency, touch it, respect that 25% and get gone. Come back to an order block, touch it, respect that 25%, get gone. You don't want to see price sitting there meandering, right? So we get our come in after midnight, get our wig snatcher, right? This is efficiently delivered, balanced price range. After that move there, that lets you know that's a balanced price range. Why? Efficiently delivered, and then you leave, right? Once you leave, balanced price range. Now it's a balanced price range. If you're bullish and you're above it, it should support price. If you're bullish and you're above it, it should cut through it like, if you're bearish and you're above it, should cut through it like butter. Okay. Tim, why are you saying that? Because right here, price is bullish, right? And it supports price, takes us up. Over here, price is bearish and it cuts through it. Once it cuts through it, look where price is coming back to. All the prices stopping right there. Now it's resisting price, right? Look over here. Now that balanced price range is resisting price because the price hadn't cut through it. All right. So when we went up, right, we got up above 2 standard deviations right here, right? And this is okay. This is the New York kill zone, New York morning kill zone that we got mapped out here from 7:30 a.m. over to 12, right? New York morning kill zone. Okay. So once we got our wig snatcher, come down, opportunity to participate, we come up to 1 standard deviation, right? And we just hang there, right? Once we get a full measure move of our manipulation leg, right? We get a full measure move of this right here. Then price just hangs out here, okay? We come there, we set a high, right? We come down, set a low, and then we just hang there, right? We just hang there inside that area there. All right. Come here, there. Come here. Okay. We come there, hang there. Once we get there, we set a high. We come back down, we set a low, and then we just hang there, right? We're just hanging there. Why are we just hanging there, right? Because this right here, that's the 4:30 candle, right? And right there, that's the 5 o'clock candle, right? That's the end of the London kill zone, right? This is the beginning of the London kill zone. That's the end of the London kill zone, right? Now that I'm putting the evidence of time on the chart, right? When we come into the London kill zone, right? When we come into the London kill zone here, right? Starting at this right here is like at 12:45. So a little ahead of the London kill zone here, we start off our wig snatcher, right? We come up, tap to the high, right? We go into the London kill zone, we get the manipulation of the wig snatcher, right? We went up, we went down. So coming into the London kill zone, right? We get the bullish Judas swing, all right? Take out the sell side, expand up, participate, go up to there, right? Make you high. So we started the wig snatcher prior to the London kill zone, right? Going into the London kill zone, we get a bullish Judas swing, right? Wig snatcher there, okay? We set a high right there during the London kill zone, right? And we coming out, we set a low there, and we hang there. Coming into the New York kill zone. Tap into the sell side. If you look very close, right? Look very close. Tap into the sell side. There. Take off. Take out the buy side. There. Go 2.5 standard deviations, right? This is the 9:30 open here, right? Go 2.5 standard deviations, right? Drop down here, taking out the sell side right there. Boom, right? Coming into the New York kill zone, we get right here, boop, boop, boop. What is that right there? That's a bearish wig snatcher, right? Going into the New York kill zone, bearish wig snatcher. Oh, but there's more. Wait a minute. Don't go nowhere yet. Don't get up and go get no popcorn just yet. Don't get no popcorn just yet. Right here is your 9:30 open. Right there at your 9:30 open. Right. We trade up here, right? Trading above that high, going up to a standard deviation, 2.5 standard deviation, and come down. So we open up, go up above that high there, right? On a lower time frame, you're taking out some buy side, right? So if you take out some buy side first, and then come down, what's that? That's a bearish Judas swing right there coming into a new session, right? Coming into a new session and coming into a new session, that high right there, that would be your pre-market high, right? That will be your pre-market high. And then right here, right? That low there that we created after we came up, set a high, set a low, right? That low that we tapped into right there, this right here would be your pre-market low, right? So when you open up at 9:30, take out buy side liquidity then drop down, right? Now you have a bearish break in market structure that gives you a bearish Judas swing. And we come down and we engage with the opposite end of the pre-market range right there. And this is where I had to write out the little signature that said, come to Papa right here, below that low right there. And we were looking at the intricate details down on the 1 minute chart of this bearish Judas swing, and then all of the movements down, looking at the 15-minute wick, looking at, the inversion fair value gaps, all the stuff on the lower time frame. Right? So as you see, when you understand the importance of time and price, the algorithm will show you things over and over and over again.
So that original pre-market low, as you've been teaching, I know that's like base hit.
Pre-market low, I'm dizzy. What you said? Pre-market low.
The pre-market low is like the base hit we've been going over, so to speak, for a while. And so
okay.
right. What you mean?
No, I'm just okay. Yeah, I never called it that, but yeah, that worked for me.
We talking about the base hits when we in and out, like that could have been like one that's in and out. But the question, I guess, is going to end up coming down to trading style. However, with that being said, and we invert that high probability gap on a 15-minute, is your trading style then to go ahead and hold, since we have that the smiley face down there, which ends up being a session low and also aligns with a 2.5 standard deviation?
Is that my trading style?
Do you find that in your experience, have you found that to be high probability, or in these markets these days, you sticking to in and out, even if that all aligns and everything? Or you just gonna say it depends on the person?
Yes, trading style depends on the person.
Right.
But if you are asking about a deviation, right? What you want to analyze in price.
Ran them. Okay, go ahead.
Okay, go ahead. Go say what you got to say now.
I was just gonna say I ran it, and the 2.5 area aligns with that low from the Asian session. So that's our Asian low. All of that aligned, and then even if you want to get out at 2, like you said, that's the beginning of our kill zone low of the London session 2. So I was like, it was 2 targets, and I was just saying it. Your experience. Have you found it to be, like I said, when all of the lines is still lining up, or is this market these days is just kind of in and out? I'm just, asking. I guess that's what I'm asking, what you've been seeing. I mean, I know we all watching it, but I would have held down to the 2, but I don't want to be foolish again. I'm just kind of starting.
What you hold for, or what you got the stomach to hold for, is going to be an individual thing. That's going to be an individual thing. There's no way that anybody can answer that for another person. But what I was going to say is, what you want to do is you want to base all targets, whether it be base hits, whether it be 10x, whether it be, no matter what it is, you want to base it off of algorithmic principles. So it matters not the market, right? The market can be extremely high volatility, right? It can be extreme high volatility, but if you get the proper entry, no matter how volatile the market is, if you get the proper entry, you're just going to have to sit through a lot of back and forth, right? But if you are getting in on an entry that doesn't account for the higher time frame protected low or high, then your stop may be subject to be in the line of fire if Phil starts pushing on the button and creating that high resistance liquidity run, right? So what you want to do, just like I said earlier today, right? I think Jada might have asked the question about it, about running the field. Where do you run the fibs from to get your projections, right? You always want to base your fib projections from the latest um dealing range, from the higher time frame, right? Like for example, just looking here, right? Looking here, this right here, from this high, once we drop down, right, and get that bearish breaking market structure at this time here, right, we have created a bearish dealing range, right? And if we want to see how far this dealing range can swing, right, we're going to use the high back to the prior low, even before we form a new low over, new high over here. We formed a new high over here. So now we can see, okay, I got to anchor it here. But this is based off of our 15-minute time frame in this case right here, right? And then whatever, like looking at the hourly time frame, it's the same area there. So you pretty much can see, okay, this is based off of the higher time frame where I want to be getting my projections from. I want to be getting my projections from here, because based off the higher time frame, this right here should be protected. And if I'm basing my projections off of this right now, I know if I come in here, right, we're going to come here and we're going to, let me chop this off here. We're just going to go to when we got our breaking market structure there, right? Right, we're going to where we got our breaking market structure here off the higher time frame there. Okay, so if we come here like that and we come back, matter of fact, we can come here, there's a low there, right? But that's where we go in there. Okay, and we extend this down there. Okay, so now we see here from there to there, right? This right here is giving us one standard deviation here based off the higher time frame. Okay, so now when we're down here in the weeds, right, when we're down here in the weeds here, okay, that's our high there that we went from. This is our low here that we went from there. So now when we're down here in the weeds like this right here, okay, and then we're looking at, we say, okay, we come here, we go up, we take out that high there, right, and we come back down and we start to drop, right? This is our highest high there, right? And if we're looking at our, right, come here like this, all right, when we're looking at it like this right here, now on this lower time frame here, right, on this lower time frame here, on this, you got 5.5 standard deviations that's lining up with just a 1 standard deviation from the higher time frame, right? So that's why I say it's like looking at saying, oh, I'm just going to go 2 standard deviations. That's all relative to the time frame that you're looking at it on. And when you're basing it And what you want to do is not look for a certain deviation, right? You want to look at your price action, right? You want to look at your price action and say, okay, right? If we come down here and we get a bearish break in market structure here, right? And now this is the top of the move, right? I'm measuring it from the top of the move. So based off the lower time frame, right now, right, with this bearish break in market structure, right, this right here, if I trade back up there, right, I'm not looking to come back here. I'm looking lower for price there. And so where's the next low that makes sense? Right here. That's the low that makes sense for this bearish break in market structure. So based off of the price action here, right, doing it from, once I get the break in market structure, doing it from the higher time frame, right, I'm looking at a 1 standard deviation move, because there's my low that makes sense, relative equal lows there. And this 1 standard deviation move is the one that's past the low right there. Okay, but measuring it from the lower time frame, right, it's a 5 standard deviation move that's past the low, right? And it's a 4.5 standard deviation move to the low hanging fruit. You know what I'm saying? So you want to understand, what am I anchoring it to? Because if we come here, right, if we come here and then we take this and we come over here to this piece of price over here, right, and we come from this high to that low right there, and say I'm looking for a 2 standard deviation move, 2 to 2.5, right? Now your stop loss, if Phil wants to put this into high resistance, right, your stop loss based off the higher time frame could potentially be in jeopardy, because this is where the move initiated. And if we go into high resistance, that's the high that should stay protected, not this one. Right. That's what I meant when I said, if you're doing it from like the lower time frames, there's nothing wrong with doing it from here, but you just have to understand that this is a fractal of price and it's not the start of the move. So this right here, you can get projections off of it based off of the algorithmic signatures, but it's still potentially in the line of fire if Phil start pushing the button and take us back for a deeper retracement. Because right now, right, inside your bearish dealing range, right, your stop is internal liquidity inside this bearish dealing range. Do that make sense?
Yes, thank you. Excuse me. And you, like on that 1 minute chart, at the 937 candle.
You say 937 candle?
So that's the swing low. Okay, I'm trying to understand the swing low that before we took out the high. That
right here. Okay.
Okay. So you wouldn't run anything from that high to that last swing low on a lower time frame.
From here to there?
Yes.
I mean, ain't nothing wrong with it.
I don't want to learn a bad habit. I'm just trying to.
No, there's nothing wrong with it, but it's just, you got to understand the time frame you're doing it on. Okay. Right? You're doing this like if you do this on a 1 minute time frame, right? It's a very small range you're looking at. So your deviations are going to be a lot more deviations because you're doing it on such a small time frame.
Okay.
So it's like you're looking at, it's like there's, like I say, there's nothing wrong with it, right? There's nothing wrong with doing it. Why? Because this here, like we come up, we drop down, we take out the high, right? We drop down, we set another high, right? So now you got your high, your high, your high, right? And then we're breaking down. We got a bearish breaking market structure, right? So ain't nothing wrong with anchoring there. There's nothing wrong with that. But since it's such a small range, right, you're going to have a whole lot more deviations that you're going to have to go through to get back to your, you know what I'm saying, your targets. Okay. Right. It's like you're going to be like here we are. We got a 2.5 standard deviation to get to that target right there. Right. This 2.5 standard deviation is based off of this right here. That's your 2.5 to get to that target right there. Right. And then to get to that target right there, it's a 4.5 point standard deviation because you go to the one beyond. If you want to play it safe, you can go to the one above it. But you know what I'm saying, that gives you a, and it's not just like the deviation that you're looking at. You're looking at a deviation to say, okay, my limit order is going to be 23,927 even, right? And people are like, where'd you get that from? Based off the institutional market structure. Excuse me. That's my target price I want to hit, right? Because we get used to saying go to that deviation, but the purpose of doing this is so you got a clear numeric value that I'm looking for 23,927 even as my target price, right? My entry is going to be whatever you entering in on over here, right? Because this is your range. So whatever you're entering in on over here, if it's an order block, is whatever inversion fair value gap, whatever you entering in over here, and your stop is going above there, right? Because that's where you got to anchor that. That's the high that shouldn't get taken, right? If you entering on this inversion fair value gap, if you entering in on an order block, whatever you entering in on, my entry is just say let's 24,049 and 3/4 at this inversion fair value gap right there. I'm just hovering there, right? My stop is 24,068 and 069. That's 2 ticks above that high right there. My limit order to get out is 23,927 even, right? That's how you set up your trade, because based off of running this right here, that gives you your exact numbers that you want to, you know what I'm saying, get out at. Then you can say, okay, I'm going to scale some off at 23,978.50, right? Why is that? Because that's the 2.5 standard deviation beyond that low right there, right? If we take that low, I want to scale some off at 23,978.50, or you can just take some off at the low. You say, I want to take some off at 23,984.25. However you want to, you know what I'm saying, however you want to do it. But the fib is giving you exact numbers to reach for based around the algorithmic structure. Like, you know what I'm saying, because the algorithm has set these lows and highs for specific reasons. You know, so there's nothing wrong with using that as long as you're using it based off of algorithmic principles. And then, like I say, you want to understand that if you're using a 1 minute range, right, and it's not like this 1 minute range is at the top of your higher time frame. So you're using the exact same high as you would be using for the higher time frame. I mean, we did this one here off of hourly, and we did this one here off of a 1 minute. So you're using the exact same high. So now you know that this high, right? Once we get all this here, now that you know this high is safe based off of what the higher time frame is giving you, even though you would have created this one prior to the hourly high being made, right? Because you creating this one right? You creating this one at this point over here. Like when we set this high, and set this high, right? That's when you're creating this one here, right? So now when we're coming down there and you just say you're entering over here somewhere because you already set your high up here inside these areas here, like I said, or you're entering here on a retracement back to this fair value gap, right? This is already set, but this hasn't happened yet. So you haven't ran this yet. You see what I'm saying? You haven't ran that yet because it haven't happened. But once this happens, right now you got the higher time frame where you can anchor it there, right? Because you say this is my manipulation leg on the higher time frame because we've come back down and got that break in market structure. And when you run that, now you're looking to see where on this lower one does it line up with the higher one, right? That I can project to. So now I ain't got the, you know what I'm saying? You don't have to move it if you don't want to, but you say, okay, one standard deviation lines up with 5.5. I can use that right there. Right here, 1.5 standard deviations line up with whatever that is down there. You know what I'm saying? And you can start picking targets as price goes down, right? And then just keep in mind, the farther it goes, the more variation you're going to start to get. Then you're going to want to refresh. You know what I'm saying? You're going to want to refresh your projection area because the algorithm is going to start referring to other things. It's not going to be referring all the way back up here no more for how far it wants to run. It's going to start referring to other things. Like, for example, if you come over here and how we've gone into this big area of consolidation, right? If we come up here and get a manipulation and then drop down again, now, right, we're anchoring it over here somewhere. You see what I'm saying? We're not referring all the way back up there because we've made a new, you know what I'm saying? We made a new low there. And now, right, now we got a new intermediate term low here, right? This used to be an intermediate term low, and then we got an intermediate term low over here. So now this is a long-term low. And so now it's referring back to this intermediate term low with high, I'm saying low, intermediate term high, intermediate term high, intermediate term high. Now that makes that a long-term high. And now it's referring back to that intermediate term high for how far can this price swing run down, right? You always want to refresh it because once you get so far, it starts to float off. That's just math in itself. You know what I'm saying? That's just math itself. At the farther you project it out, the less accurate it becomes. You start getting that more variance inside the math. Hopefully that made sense. It made sense in my mind, but
yeah, no, it makes sense. And then that's almost like when it formed like that smiley face with the shoulders. You almost like, because we've come back up, we project from that new dealing range inside the main one, in a sense. Okay.
Mm-hmm.
Okay.
Yep.
That makes sense.
And it's just like you said, with a new dealing range, just like any, you know what I'm saying? Like when we're looking at a dealing range, right? And we say like, okay, all of this is efficiently delivered. So we're looking at this portion of this dealing range, this expansion leg of this dealing range right here, because the algorithm has efficiently delivered all this right here. So we're not referring all the way back up here for it to come up to a premium, right? We're coming back to, right, the latest expansion of the entire bearish dealing range. Why? Because it's like, there's no need to come all the way back up there, right? It's like we done got long in the tooth of this range, right? Same concept to it. It's the same concept, looking at that latest expansion leg. All right. And then what we have to remember, right? Yes, we can see algorithmic principles inside of this consolidation. But when prices in this, like this right here, just leave it alone. Save yourself headaches. Listen, people, save yourself headaches, save yourself blown evals, save yourself broken monitors. When price is doing this right here, just leave it alone. I don't care if it is the New York morning session and you just got the trade save yourself headaches and come back another day. Come back in the afternoon. Just come back sometime when it's not doing this right here, right? And just zoom out and look at price. Zoom out and look at price and notice, right? Price will move, then it'll do something, right? It'll move, then it'll do something. What is that something is doing? It's cooling off. You know what I'm saying? It's cooling off. So if price cooling off in the morning, come back in the afternoon. It's probably gonna give you something. If price give you something like this in the morning, the afternoon probably just gonna do this, right? So don't come back in the afternoon looking for a continuation of this. Can it happen? Yes, it can, right? Yes, it can. But the way price operates is it's gonna move, cool off, move, cool off, move, cool off. Why is that? Right? Because price is gonna consolidate, expand, retrace, and deliver, or it's going to consolidate, expand, reverse, retrace, and deliver. Right? When do you want to be participating? Right? You want to be participating on that delivery leg. Right? That's when you're trying to get in on that delivery leg. What does that mean? Right? You got to let it consolidate. You got to let it expand, right? If you know this expansion right here, right, is the expansion of manipulation, then you know you're down here. If you know that this expansion right here is the expansion in the direction that you need to go, you know you're up here and you're looking to get in on that retracement so you can participate on the delivery leg, right? But when you see it consolidating, don't try to force nothing. Wait until it shows you if it's going to expand in a direction you need it to go, or if it's going to expand in the opposite direction, right? All right. Remember that. And then always be prepared for, are we getting a wig snatcher, or has the wig snatcher already initiated itself? Right? Has it initiated itself? Right? Just you always want to see, where are we in price? Just like over here, when we was looking at the London session, we said that the wig snatcher started out prior to the London session. We went above the high, and then in the London session, we got the Judas swing, right? So we got to be able to look back and see, okay, we're dropping down away from the draw, right? We're dropping down away from the draw, and then we displaced up, right? But Tim, why you say we're dropping down away from the draw, right? Look at what price did. Price came to a daily high, just barely poked above it. And we're just working that daily high, refusing to drop, right? Anytime you come to a higher time frame level like that right there, right, and you don't dig up into it, if you just poke above it and start to pull back and you're refusing to just take off away from it, right, price ain't finished up there or down there yet, right? Like we always say, like y'all always hear me say, I want to see a deeper dig into that liquidity up there. Why? That's a major pool of liquidity, right? So I want to see it get up in there, like a wedgie, right? Drop away from the draw. So see, when you see it drop away from the draw, what you want to do, look back to see if we already force breakout traders in, and are we punishing them now, right? If we did, then we're just looking for that Judas swing so that we can participate. That's the manipulation leg, expansion, get there, right? If you're more advanced, you can look for entry down here in that manipulation, like down in that manipulation, giving you a good opportunity to participate while you're in that manipulation. But if you ain't more advanced, right, then you just wait for the expansion and get in on that retracement to participate in that delivery. Right. That's all I got. That's all I got. What up, Pinch Fly? Tell Empire Traders I said, what's up? What's going on? Lump and came up in here. Miss V done came in. We got Jada done popped in. LB says standard deviation anchoring. That was a gem. LB, make sure you look at the videos. Look at the videos pertaining to institutional market structure that Michael be teaching like where to anchor your fibs at. You don't want to just stick it on any random high and low. You want to know why you anchoring it to that high and why you anchoring it to that low. You want to do it based off the institutional market structure. You know what I'm saying? Have we come into a pool of liquidity where we anticipate the price to reverse at? And then if we have, we're looking for price to give us that institutional market structure. And then you have a swing low on that manipulation leg that you use to project from, or you can also use one from your entry leg, your entry price leg, and you can look for confluence between the two anchor points. You look for confluence in the deviations, right? If you got them falling right in beautifully, lining up beautifully, you be like, oh yeah, I got a tiger by the tail. But yeah, don't just go out there and willy-nilly be like, oh, I just seen something cool on Tim live stream. Let me go try to do this right here. Because that price will get you. Be looking at you like Cletus Clump grandma. Got you. What's wrong, Mr. Cletus? Remind you of somebody? Mr. Johnson, perhaps? Gotcha. All right, man. That's all I got. I don't see that in the chat. Tomorrow is Thursday. No tape reading session. There's a football game tomorrow night. My son plays in the marching band, so I will be at the football game supporting him. My older son has graduated. He no longer plays high school football, but my younger son is still in the marching band, so father shall be in the stands. Right? Only difference is after halftime, I probably will be going home. Because probably not going to be interested in the game at all. You know, just waiting for the band to take the field and do their thing, and so that I can leave. Yep. Anyway, appreciate y'all for hanging out with me. If y'all got somebody this, share it with somebody that you know that's trying to do this right here. Maybe they'll get something out of it too. I'm on day 3 of my fan. Right, I'm on day 3 of my fan, and I haven't charged it. It's still going off of one charge. Right.
Come on, man. That's what we do around here, man. You know what I'm saying? Top quality merchandise, man.
Oh my God.
Yeah, you know I mean.
Oh my God. I shouldn't have said that. I shouldn't have said
Get you,
nothing.
got you, guys.
I should have said nothing about this fan. Anywho, that's all I got, man. If this is first time tuning in to Tibbs Tidbits, you probably not here for this long. You're probably not here no more. But if it is and you still are here, I appreciate you for hanging out with me. And I will see you maybe Friday. I won't do a live stream tomorrow evening. And Friday, I don't think I got nothing going on. I don't have my phone in here with me. I can't look at my calendar. But I'll see the mentees. I mean, the Diamond members. I see the Diamond members Friday morning for tape reading. And stepped away for a second. Did you see the question above? What question? You put a question in the chat here to learn and share? Oh, no, Nagara. How you get the confidence to hold on the 1 minute chart when in it? Nagari, you still here? We kind of covered that with when I was talking about Yolanda, when I was answering Yolanda question. Nagari, you still here? Look at here, Learner Shell coming up here being teacher's pet. Mr. Rogers, Mr. Rogers, did you see somebody had a question? I guess Nagara not in here no more. So Nagara, if you are in here and you just type slow, when I was going over the projections with Yolanda talk about different projections, that's how you gain the confidence in holding, because you're looking at, okay, algorithmically, these are within reason. These targets are within reason. And then after doing it and seeing it happen, you build that confidence in, okay, I can hold it. This retracement is not scaring me because this retracement is allowed and this expansion is allowed. All right. But Nagar, keep tapping in. We'll get you there. Even though I know you ain't here no more, because I ain't never seen that name before. And you know, people that be here for the first time and then they don't realize I don't be watching the chat, and then I don't answer their question, and then they get mad and stomp off. Like somebody that stole their bike. They feel like they went to the store on 6th Street one night to get something, and they was in the store, and their little brother was supposed to been outside watching their bike. And then when they go outside, they bike not there no more, and they go back in the store, and their little brother standing over there because they want to come in and see somebody play Super Pac-Man on the arcade game. And they'd be like, what you doing in here with my bike? And they'd be like, oh, your bike outside. And then you go outside and be like, well, and they'd be like, it was right here. And then you have to end up walking home in the middle of the night because you ain't got no bike.
Man, y'all should have had some locks for y'all bikes back then. What y'all got going on, man? I would have had a lock for my bike, because if Super Pac-Man just came out, that seems like it's extremely important, and you got to get in there and see that,
man. Okay, it's extremely important. It was extremely important. It was Super Pac-Man.
Well, I think it probably was Donkey Kong or something. It might have not have been Super Pac-Man. It might have been something. It was Super Pac-Man.
I'll never forget it. Okay. I'll never forget
it. Hey, man, it wasn't up on the bicycle, man.
Some scars never heal. Some scars never heal. Hey, I appreciate y'all, man. I'm gone. Look here, man. This stuff really works. You know what I'm saying? I'm not here trying to, I ain't here trying to, you know what I'm saying, blow no smoke or nothing like that right there. This stuff really works. If you take the time to learn Michael's core content, right? And then you take the time to go back and look through price action and study what price is really doing in reference to time and price. When time and price align, you know what I'm saying? You got to get like Ant-Man. You got to be able to look back through them candles to see when time and price align. And you know what I'm saying? Y'all starting to see it. Y'all starting to see it. Y'all folk been like, you know what I'm saying? Folk like Seawalk and Deborah and Lump and a few people, they've been like, man, Tim, you've been on fire, man. And I don't know what lately been. Guess what, y'all? I'm seeing the same thing that I've been seeing from way back when. That just makes sense to y'all right now. You know what I'm saying? Y'all speak Japanese candles fluently now. So now when I step up to the mic, instead of hearing y'all hear breaking market structure, retrace back to an inversion fair value gap. That's the first inversion. That's the first fair value gap that we had when we displaced at the anticipatory reactionary point. So when we inverted it, we're looking for that to be a high probability inversion fair value gap. Now you understand that. But before, when I said that a long time ago, all y'all heard was right.
Hey, that's real now. That's real. My Mandarin starting to come in good right now.
Yeah. So, hey man, shout out to y'all for putting in the work. It's not a sprint, it's a marathon. It's not gonna happen overnight. It didn't happen overnight for me, right? When I first retired, right? I didn't retire, like the stock market didn't retire me, right? The stock market gave me the confidence to go ahead and follow my plan. But when I retired, I was just getting introduced to the ICT concepts. And boy, look at here. I was OTE timid. That's the first thing I ever heard of from ICT. OTE. I was OTE timid. I was running fibs on any high and any low, trying to get an OTE entry. I was OTE timid. And when I tell you I went down through some money, I did back before I wasn't even trying to trade prop firm. They used to call them combines. I wasn't trying to trade no combine. I just retired from my job. I wasn't trying to work for nobody. Combine, trading other people money, working for people. What? No, how dare you ask me to work for somebody? Man, I was going down through some money. Man, you couldn't tell me I wasn't super trader. I was super loser too, right? But it ain't happened overnight. It ain't happened overnight. And now, you know what I'm saying? I said, man, I just want to be able to read this price action just almost as good. It ain't got to be as good as Michael. I just want to be able to read it just almost as good as him so I know what to do. I don't want to be looking for one stupid model. I just want to be able to understand this. And then that start making sense. Just like it is for y'all. It's starting to make sense, right? If you don't overcomplicate it, if you don't interject your feelings, you look at what price is telling you. Price will tell you when you should leave it alone, and price will tell you when you should participate. Right? Will it happen during the time you want it to happen? Nope. But if you're patient and you submit to what the charts are doing, right? If you block out the noise on social media, you know, every single day I get on YouTube and I see somebody posting a video how they made $4,000 today, how they made $10,000 today, how they made $3,400 today, how they made all this money today in less than 30 seconds, in 5 minutes, in an hour. I made this every single day, right? And then I'll be sitting there looking like, man, I ain't taking trades every single day. Especially not no $3,000 trades every single day, right? So you can't let all that affect you. You can't let that noise that people talking affect you because you're thinking, man, if they can make $3,000 a day, why can't I make? Like my homeboy be like, Dad, how much can I pull down every day? That don't exist, man. That don't exist. That ain't no such thing. But if you learn the skill, you can just decide, okay, this how much money I need to make in a year. Then you do it backwards. And you do it backwards. You be like, okay, right now, my family, between me and my spouse, right now, my family living off of $180,000 a year between me and my spouse. Right? If I stop working at my job, I need to be able to bring in $90,000 a year off of trading. Now, is that a gross number? Is that a net number? Whatever your number is, I don't know. But if you say, okay, I need to bring in $90,000 gross off of trading to replace what I'm leaving from. Then you say, okay, it's 12 months in a year. All right. Y'all done got me talking now. All right. You say it's 12 months in a year. You say, I between me and my spouse, we're living off of $180,000 gross right now. Right. If I leave my job, I need to bring in at least 90,000 gross a year. Right. It's 12 months in a year divided by 12. Right. So I need to bring in at least $7,500 gross a month, right? Typically, well, to do it the easy way, I'll just go 90,000 because it's, what is it, 52 weeks in a year? Is it 52 or 56? 52, 26, 20, 50, 12, 4, 52, right? So it's 52 weeks in a year. So it's 52 weeks in a year. That means I need to make $1,700. If I can make $1,750 a week, right? Gross, I can replace my income. Now you know how much you need to make in a week. All right. Now you know how much you need to make in a week. So we're just going to round up for easy math and say $1,800 a week, right? And let's just say you trade the NQ. If I trade the NQ, divide 1,800 by 20, right? Because the NQ is $20 per point. That's 90 points per week, right? That's 90 points per week. And then you say, okay, I'm not going to trade every single day. Let's just say I find 3 setups a week, right? 90 divided by 3, 30 points per trade. 30 points per trade, 3 trades per week will get you $90,000 gross. All right. Now, when you think about your number and you reverse engineer your number and do it in a realistic way to you, you figure out it's really not that hard to get what I want out of this right here. And then so you don't have to ask somebody, Dick, how much can I pull down every day? It don't matter how much you can pull down every day, because all I need to do is find 3 trades a week, right? Find 3 trades a week where I profit 30 points. Am I saying I'm never going to lose? No, I'm not. But I just got to have 3 trades a week that I profit 30 points. And make sure every loss that I take is less than 30 points. Right? So if I take 5 trades in a week, 2 of those trades, let's just do a 1 to 2 risk to reward. 2 of them trades, right? I take a 15-point loss, right? And then 3 of them trades, I take a 30-point win, right? Yes, I'm only up 60 points for that week, right? But guess what? I'm still up and I'm really close to my number, right? I'm really close to my number for that week. But guess what? I'm in the good, right? I'm in the good. Let's say if I took 5 trades and I only lost 1 throughout the week. I took 5 trades, but I only lost 1, right? Now I'm up 45, no, 36, 90 plus 15 was 90 plus 15, 90 plus 15. Was that 105, right? I'm up 105 points because I 4 at 30 and I lost one for 15. So you take 15 off one of them 30s. Right? But the less you trade, the more accurate you're going to be because you're opening yourself up to less risk and you're taking better entries. The more entries you take, the more susceptible you are to taking a loss. But if you're only taking 3 trades per week, you're waiting on like the cream de la cream. And for those who speak French, that's the creme de la creme. Right? So reverse engineer your number. Figure out what you need, right? If you desire to leave your job, figure out what you need for your family to be able to sustain the same level of living, and then reverse engineer it, right? Reverse engineer it. All right. Y'all take it easy. Go spend some time with your family. And get ready to let's do it all over again tomorrow when the market says go. You know, if you trade the Asian or the London session, the Asian session, you probably watching the charts now. It's after 7, right? This the time when you start looking at the looking for the buy and sales programs to you know start to kick in. Tomorrow we got PPI at 8:30, along with job numbers. I think it's 8:30. I think it's 8:30. Yes, PPI at 8:30, along with the jobless claim, right? So PPI typically is not as volatile as CPI, but still job numbers in PPI is high impact news. So if you trade the pre-market, be careful around 8:30. Make sure you're not in a position. Then yeah, then you got retail sales on Friday and industrial production at 9:15. That's a weird time for news, 9:15. But 8:30 and 10 is like the more typical times for like the high impact news. Sometimes you see like a 9:15 and a 9:45. Those be like mess with my brain. But yeah, that's your news for Thursday and Friday. I'll see y'all, the Diamond members, Monday at 9 for tape reading, and everybody else at 6 on Friday for price action recap. Thank you again for tuning into another episode of Tim's Tidbits. Till I decide to get on Algo's internet and share my thoughts on this thing that we call price action. That is, it's your boy Timothy Lee Rogers Sr., aka Aranya Grande. That's just big spot if you don't hablo Espanol. Y'all be safe out here in these trading streets, man. Gone. Yeah.